as some of you might know or might not know, I'm actually an economist. Now, the one thing I found was studying economics, and I just started out trading, and I've been trading since 2000, is that economics don't make you money in the market. But luckily, I discovered Joe's book back in 2002 in South Africa, and it helped me a lot tying fundamentals together with how to enter and exit and trade your ideas in the market. So what we're going to do, or try to do today, is use simple economics to look at the yen and see, is the yen in trouble? What's the Bank of Japan going to do? Likely, I cannot predict the future. But, and then look at how DiNapoli levels can help you to go further with this view and see which thing is more important at certain times. So we're going to be looking economically at what drives currencies. I'm going to be looking at if the yen is in big trouble or not. And then we're also going to be using the DiNapoli levels for this, as I said. And then we'll do a quick summary on that. I've been introduced, I manage a hedge fund in South Africa. I travel the world teaching this method, been everywhere. Okay, so let's take a look at what drives currencies economically. So I've split this up in different time frames. Let's say very short term, ultra short term. So ultra short term, currencies are driven by economic events like economic news releases, CPI, jobs, interest rates, right? And then, especially in the Japanese yen's case, central bank intervention can have a really serious impact on short-term time frames. I'm also going to be looking at how the DiNapoli levels actually help with the most recent central bank intervention happened a year ago, I think, but we'll look at that shortly. Then we'll move on to short to medium. Okay, so the carry trade. David was actually mentioning the carry trade when we were speaking earlier, and it's come back recently since the US has raised interest rates. And I mean, Japan's interest rate is near zero. It was negative for a while, now it's back at 0.1. So you borrow money cheaply, invest it, and you gain a profit, right? The effect of that on the medium term is the currency goes weak, the yen specifically in this case. Okay, so what I specifically also like to look at is the real rate difference. So the real rate difference is if you take the interest rate of a country and you strip out inflation. So if inflation is more than the interest rate, you're actually losing money. While if the interest rate is more than the inflation, you're making money in real terms. And then you compare these two countries' real interest rate difference with each other. Now, this carry trade can have an impact on currencies for months and even years. It also starts to create a negative sentiment around specific currencies like the Japanese yen at the moment. Nobody wants to own it just because it's a snowball effect, just keeps on going. Okay, and then we move on to long term. Now, I said medium term, short to medium term could be years. Long term, there's only one economic factor that really influences the currency's value, and there's a lot of Federal Reserve studies on that, and it's called purchasing price parity. Now, some of you might have heard about the Big Mac Index. This is a little bit more than the Big Mac Index. It's a real basket of real things, and the OECD does a lot of studies on that, so I'm going to try and break this down, but this is really the anchor between currencies, and it boils down to inflation. If you think about countries who has really seen weak currencies, I'm thinking Zimbabwe, I'm thinking Argentina, recently Turkey, runaway inflation. So let's take a look at what is driving the yen currently, and is the yen really in big trouble? At the moment, the big driving force is the carry trade. Okay, short to medium term, we talked about the carry trade. This little chart here is a simple chart just showing the value of dollar yen in orange versus the real rate difference, which I explained earlier, the rate of interest minus inflation of the two countries compared. Now, what you'll see is if the real rate difference goes down, it means there's no carry trade, so you don't lend yen, the yen will shrink. If the real rate difference, which is charted on the right, goes up, you'll see the dollar yen goes up. So the real rate difference have been going down because of the low inflation in America, and now all of a sudden the inflation in America got very high, so America raised interest rates way faster compared to their inflation actually versus Japan, which caused yen to flow out of Japan into the US most likely, and maybe some other countries, to capture this carry trade. And you can clearly see the driving force this has on currency values. Okay, so we know the carry trade is driving the yen, but what is the value of the yen supposed to be? We're going to use purchasing power parity for that. And if you compare, you take the OECD data and you compare it over since 1977 when we went off the gold standard, and you compare the purchasing power parity with the value of the yen for each year. This is the chart you get. The correlation between purchasing power parity and the value of the yen versus the US dollar is about 77%. Okay. Over the long term. The purchasing power parity, which is the comparison of prices in the two countries for the same stuff, versus the value of the currencies over time, has got a 77% correlation very long term. Some currencies actually, some is better than others, but like the dollar rand, which is my currency for South Africa, has got almost 90% correlation with purchasing power. Okay, so where are we now? There, the orange dot. That's where we're sitting currently in the dollar yen versus purchasing power parity. So what this is telling me is we're expensive, or actually the yen is undervalued, the dollar is. So the yen is undervalued long term. So even though we've got this driving force medium term, the carry trade is weakening the yen, purchasing power anchor is telling me the yen is actually getting quite cheap. Now that's easy to say long term. How do you make money out of it? And that's where the DiNapoli levels come in. So I'm going to first show an example of ultra short term. Remember economic events, central bank intervention. First I'm going to show that, and then we're going to move on to the longer term analysis and the central bank analysis. As a side note, I've been trading this currency, the dollar yen, and watching it since 2009. I've traded the big earthquake, Fukushima, and all that. So I'm very, very familiar with this currency, even though it's not my own currency. So this is a yearly chart of the dollar yen. And I believe I stopped this chart. Go back. I stopped the chart over here in 2020, 21, somewhere there. That's a yearly chart. It's showing ABC expansion with OP resistance 149.31. Remember that number, 149.31. Okay, so we know about that level back in 2021, right? So we fast forward now, I believe this was last year around. There's the line, 149.31. See that? This is now a weekly chart. Do you also see the XOP on the weekly? 151, I think 48, the number. Okay, so I'm taking very big yearly levels, weekly levels, to determine very short-term impact. That's strange, don't you think? But yes, that's the way it works. So where will the central bank most likely intervene in the market? It's at these critical levels. And there's a whole video on our YouTube channel actually about this. So let's fast forward and see what happened at this level. So if you're in on the carry trade, these levels are where you're at most risk for getting run over by the Bank of Japan. Maybe, maybe not. Okay, let's move on. So this is the daily chart. You see that high there, the weekly numbers, the red line, the green line, that's the yearly XOP, the weekly XOP. This is the daily. Boom, boom, boom. That was the day that Bank of Japan intervened in the currency. Okay, so that was short-term impact, but using long-term levels. Yeah, and we knew about that years later. Okay, moving on to short and medium term, the carry trade, the one that's driving the market. How do we analyze that using DiNapoli levels? We use the quarterly MACD predictor. Look at how clearly it captures the trends of whether there's carry trades or not, and the medium-term driving force on this market. Okay, so we know sentiment is driving this market. When will it stop? Most likely when we get close, or this MACD predictor, and you can see it's moving. That's why it's predicting it's ahead of time. It's 1/4 ahead of time. When this thing will get closer to the market, which can happen in one or two ways, is obviously the market can go down to it, or the market can go sideways, and this will creep up. But that's when sentiment will most likely turn. Okay, so long term, I think the yen is getting too high. Can I sell the yen yet? No, because the sentiment is still not telling me. But where can it go? Again, we look at our yearly DiNapoli levels on the dollar yen. There you can see the 14931 where the central bank intervened. You see that level. But we're above that now. So I doubt the central bank will be intervening soon. Remember, it's unpredictable, but the next real level of resistance is around 180 on the yen. So this is telling me, unless we get up to that 180 zone, or unless the sentiment indicator turns, it's dangerous to still be selling dollar and buying yen. If you rather want to join the carry trade. You see, so it helps me filter between two economic things. It's telling me different things. It's telling me carry trade is still in control, but we know exactly where this carry trade might lose steam. It's either going to be 180, or it's going to be when the MACD predictor on the quarterly starts to show us. One thing it also shows us is this 147 level, 149. You remember where the central bank intervened? If we get back below that level, which in all likelihood the quarterly sentiment will be turning anyway, that's also going to be telling me, okay, the carry trade is most likely over. Okay, so let's take what we've seen from the economic side, and we'll take what we've seen from the technical side, and let's summarize and try to figure out what the Bank of Japan will most likely be doing. Okay, so possible switch. Okay, so the purchase price in parity showing us the yen is already cheap. But how do you stop the depreciation of the yen when you're a central bank? How do you turn around sentiment? You can still intervene at critical levels, and monthly and quarterly DiNapoli levels will be helping us with that, to know where these risk levels are. But that's short term. Okay, so to summarize, the Central Bank of Japan can do a couple of interventions or changes. At the end of the day, a test of 180 looks very possible as long as we stay above 147 on the dollar yen. Once we get to 180, I'll be watching this very, very carefully and definitely considering for myself, long term, maybe on a small portfolio or something, own a little bit of yen. That's it. Thank you.
This is Pieter van Wyk. Thank you for sharing us today.